a lot of people are obviously aware that businesses are going through, a lot of different challenges with COVID at the moment and what that's doing to businesses. The vast majority of people that we're talking to have got challenges both at the operational level, and a lot of that's been solved with some of the postponing of payments around rent and furlough of staff, etc. And there's a lot of sales challenges for businesses as well. But also, there's quite a number of challenges regarding funding and what's going on in terms of balance sheets and cash flows within businesses as people hold back from spending cash. So what we're really seeing, I think, across the client base is more businesses become more challenged around their current funding position and looking for support from their banks, in fact. So going to the banks and having actually predominantly very good conversations with banks around how they can support them.
And what do you think that means for businesses and their debt and perhaps their covenants as well moving forward?
Yeah, well, I mean, certainly at the moment, there's a lot of covenant breaches. People are struggling in terms of their profitability against where they were forecast to be. That's leading to a breach on the covenants. And by and large, the banks are really given the opportunity to say, well, actually, there's no point in really testing it in the current environment, no point in looking at what this covenant should be. Let's just waive where they are at the moment, give you time to breathe, and then look at really resetting where the covenants or reintroducing the covenants towards the back end of this year. So at the moment, it's very much a sort of put a pause on the covenant tests and how they're being treated. But certainly the banks won't keep that stance forever. And towards the back end of the year, I think we'll see those being reintroduced again.
Yeah, I think that's really interesting. And obviously it creates some nervousness and some challenges for the business owners as well as they're trying to navigate their way through to understanding how far they're going to be waved forward. That must make some business owners feel really worried.
Yeah, I think so. And what the big challenge is for a lot of it is that it's just the uncertainty that's going to be there. I think really as we come out of lockdown, what does the restarting of the economy really look like? And we might see a short-term bounce back that gives a bit of confidence to everybody. But I think as we see businesses start to struggle again and employment numbers go down, that will obviously have an impact on confidence, and confidence ultimately leads to people not spending money. And so we might see a small improvement in the short term, but actually the risk is that the longer term picture, we see a dip in the economy again, and that has an impact on the business. But what that looks like at the moment, there's a lot of uncertainty for people.
Yeah, so with that longer term question mark and that short term perhaps opportunity or grace period in regard to attitudes towards covenants, what do you think business leaders need to be thinking about now in order to just secure their short and mid-term future?
Yeah, so I think the first thing to do is acknowledge that covenants will come back in at some point. And it's probably going to be towards the back end of this year. I think businesses have been given a 6-month grace period, but they will be reintroduced. And what's important is that when they're introduced, they're reset at the right level, because they are meant to be a set of flags around whether the business is performing and making sure that the bank really isn't going to have any concerns about the repayment of its debt or its security position. So they're really there as a set of flags to identify where there may be issues that need some exploring. But if they're set at the wrong level, they can produce a set of handcuffs, actually, and put a lot more constraints on businesses inadvertently. And I think what's really important now for people to be thinking about is what the new normal would look like for their business, how trading might look like in a world where they're not just looking at 2019 and saying we're going to get back to normal again. So what's that look like for them as a business, and how it might change in terms of their performance and their cash flows and their assets and their working capital requirements. So starting to think about that now and starting to build some forecasts in place which enable them to look at that, which ultimately will lead to some alternative covenants being put on the business that will give them better freedom than maybe some older ones that are really obsolete.
Yeah, I think that's really interesting. I think that's absolutely the right thing. There's some really high profile case studies at the moment. I mean, you look at someone like Hertz, who grew because of smart management of debt, but ultimately that's been the reason why they've come undone, and tens of thousands of people have lost their jobs and lots of people have lost a lot of money. But the public nature and the scale of some of these businesses means that is actually kind of easy to read live case studies, which is an opportunity. But that doesn't necessarily mean it's easy to then know what that means for each business. So if someone's unsure about what resetting their covenants means for them and their company, what can they do to go about finding an answer as to where the covenant should be from their perspective?
Yeah, so obviously the first thing to do is to revisit the business plan and see what that looks like. Again, it's meant to be that covenants are set as a guide as to whether you're on the plan. Making sure that you get the right lending in that fits that plan is important. So it may mean that actually you need to look at the current borrowing and identify whether it's the right structure, whether it's the right type of debt, whether it's got the right term associated with it, or whether actually you need to introduce some alternative funding such as equity or an alternative lending provider. Maybe you move from a cash flow facility to an asset-based lending facility. So I think there's various options around that. I think then, once you've revisited the forecast and seen what you can do, and then mapped out what the right sort of debt is against it, I think having a steer as to what covenants are being offered in the marketplace is important. Because again, banks will vary in terms of what they're offering on covenants and their view towards how they review them. But by making sure that you've got the right ones in place with the right institution, will again help free the management up to go and run the business, as opposed to just worrying about whether they're hitting a quarterly forecast.
Yeah, absolutely. And I think you've touched on two things which probably mean we should get back together again and do another video. But forecasting and that capital structure, that mix of debt, equity, retained profit, and how those two things come together. That forecasting capital structure bit is key. So maybe what we can do is come back together and record another video talking about thoughts on those two topics.
Yeah, I mean, certainly a view that the equity markets are going to be pretty key in terms of plugging balance sheet holes at the moment. And, we're just waiting, I think, for the next version of 3i to crop up to help enable that. But no doubt there will be things starting to come out. And I think there's a lot of equity providers out there seeing this as a real opportunity to get some money out to the marketplace.
Yeah, I think that's absolutely right. So let's connect again in a few days and do the next video on the next part of that, forecasting capital structure and the link to equity financing.